Most traders don't lose money because they don't know how to click buy or sell. They lose because they treat trading like a lottery ticket instead of a profession. In fact, studies show that more than 80% of new traders blow their accounts within the first few months. And the biggest reason? Poor risk management. Think about it. You could have the best trading strategy in the world, but if you're risking half your account on a single trade, one bad move is enough to wipe you out. Trading without risk control is like driving a car at full speed without brakes. It feels exciting until the crash happens. So let me ask you this. How much should you risk on a single trade if you only have a $100 account? Is there a difference in risk when trading crash and boom versus Forex pairs? And how do you set up stop losses and take profits without choking your strategy or blowing up your balance? If you don't have clear answers, don't worry. That's exactly why you're here. In this Risk Management Masterclass, I'm going to break everything down step by step. We'll talk about how to set risk per trade, how to size your positions correctly, how to use leverage wisely, and why most traders fail when they ignore stop losses. And here's the best part. This is not just theory. I'll show you real examples with small accounts and bigger accounts, so you can see how to actually apply these rules on Deriv. Whether you retrading volatility, 75, crash and boom, or even Forex pairs. By the end of this video, you'll not only understand risk management, but you'll also have a personal game plan to protect your capital and trade smarter in 2025. Because remember, in trading, survival is the first victory. Why risk management matters. Let us start with the most important truth in trading. It doesn't matter how good your strategy is if you don't know how to protect your capital. Imagine a trader who has a 60% win rate. That sounds amazing, right? But here's the problem. If that trader risks 30% of his account on every single trade, a small losing streak is enough to wipe him out completely. On the other hand, a trader with just a 40% win rate could actually grow an account if they use strong risk-to-reward management. That's the difference between gamblers and professionals. Gamblers think in terms of this one trade must win. Professionals think in terms of over the next 100 trades. How much of my account will I keep? And how much can I grow? Risk management is what keeps you in the game long enough to let your strategy work. Without it, even the smartest signals or the most advanced strategies will eventually fail. Risk per trade and position sizing now. Let's get practical. The first rule of risk management is simple. Never risk more than 1 to 2% of your account on a single trade. Here's what that looks like. If you have a $100 account, 1% means risking just $1 per trade. If you have a $1,000 account, 2% means risking $20 per trade. It doesn't sound like much, but here's why it works. With this approach, even if you go on a losing streak of 10 trades in a row, you'll still have 80 to 90% of your account left. That means you can keep trading, adjusting, and improving. Now, let's talk about position sizing. The formula is simple. Position size equals account balance times risk % divided by stop loss in pips. Example, let's say you have a $1,000 account. You're risking 2% $20. And your stop loss is 50 pips. That means your position size should be 40 cents per pip. This way, even if the trade goes completely wrong, you lose only what you planned, not your entire balance. On Deriv, this becomes especially important when trading synthetic indices like Volatility 75, which move much faster than Forex pairs. Without proper sizing, one spike can liquidate your account instantly. Stop loss, take profit, and risk to reward. Let's talk about one of the most ignored tools in trading, the stop loss. A stop loss is not there to limit your potential. It's there to save your capital. The truth is, no trader wins 100% of the time. The best traders win between 50% and 70% of the time. So if you're not using stop losses, one losing streak will wipe away months of profits. Here's how professionals think. If you risk $10, you should aim to make at least $20 or $30. That's a risk-to-reward ratio of 1 to 2 or 1 to 3. This means that even if you only win 40% of the time, you can still be profitable in the long run. But what do beginners do? They flip this ratio upside down. They risk $50 to make $5. That's why, even with a high win rate, they always end up broke. So remember, your stop loss protects you, and your take profit rewards you. Together, they make sure your account grows consistently, instead of shrinking unpredictably. Leverage and multipliers on Deriv now. Let's talk about the double-edged sword of trading. Leverage on Deriv. You can choose leverage as high as 1 to 1,000. That means with just $10, you can control $10,000 worth of trades. Sounds powerful, right? But here's the catch. Leverage magnifies both profits and losses. Let's say you have $100 in your account, and you take a trade with 1 to 1,000 leverage. If the market moves against you by just 0.1%, you could lose your entire balance in seconds. That's why professionals don't use maximum leverage. They use leverage strategically, usually between 150 and 1 to 200, because it gives them flexibility without exposing them to unnecessary risk. On Deriv, there's also the multiplier system for synthetic indices. Multipliers are basically leverage applied directly to your stake. For example, if you enter a $5 trade with a 100x multiplier, you're trading as if you had $500. Again, it's tempting to go for 1000x multipliers, but that's basically gambling. The smarter move is to use moderate multipliers, combine them with strict stop losses, and focus on steady growth instead of one lucky jackpot. Risk management for synthetic indices. Synthetic indices are unique to Deriv, and they require a unique risk management approach. Why? Because they move differently compared to Forex or stocks. They're designed to be highly volatile and trade 24/7. This means while opportunities are everywhere, the risks are equally high. For example, trading crash 1000 is not the same as trading EUR, USD, crash and boom. Indices can spike hundreds of points in seconds. If you're risking too much or not using a stop loss, your account can disappear instantly. The best way to handle synthetic indices is use smaller position sizes. Stick to your risk per trade rule. Always set stop losses. Never chase losses after a spike. Remember, the volatility that makes synthetics exciting is the same volatility that destroys accounts. Respect the market, and it will respect your account. Quick pause before we continue. If you're trading on Deriv and want to save money, here's a pro tip. Coupontera offers exclusive discounts and coupons for Deriv accounts and trading tools. You can find them directly at coupontera.com. And if you want reviews, guides, and tutorials before using a coupon, check out propfirmask.com. Why pay full price when you can get the same tools and accounts at a discount? I'll leave the links in the description below. Now, let's get back to mastering risk management. Final tips in trading psychology. Risk management isn't just about numbers. It's also about psychology. How many times have you lost a trade, then immediately tried to win it back by doubling your position? That's called revenge trading, and it's one of the fastest ways to blow an account. The key is discipline. Here are a few rules that professional traders live by. Never risk more than your plan allows, no matter how confident you feel. Take breaks after big wins or big losses. Emotions cloud judgment. Keep a trading journal. Write down your entry, exit, stop loss, and how you felt during the trade. Over time, you'll spot patterns in your mistakes and fix them. Remember, trading is a marathon, not a sprint. The goal isn't to double your account overnight. The goal is to build consistent growth that compounds over weeks, months, and years. The secret to long-term success on Deriv is not finding the perfect entry. It's about managing risk like a professional. Keep your risk per trade small, size your positions correctly. Always use stop losses, respect leverage, and control your emotions. Do this, and you'll not only survive in 2025, you'll thrive. And don't forget, if you're reopening an account or buying tools for Deriv, check out propformask.com and coupontera.com for exclusive coupons and discounts. Trade smarter, not harder. If this video helped you, hit that like button, drop a comment with your biggest trading lesson, and subscribe to the channel for more tutorials. Because in trading, survival is the first victory. And now, you're ready to trade smarter in 2025.